Ladies and gentlemen, good day and welcome to Aditya Birla Sun Life Asset Management Company Limited Q4 FY23 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jinesh Asyal from InCred Equities. Thank you, and over to you, sir.
Yeah, thank you, Nirav, and good afternoon, everyone. On behalf of InCred Equities, I welcome all to Aditya Birla Sun Life Asset Management Company Limited conference call to discuss the financial results of Q4 and FY23. We have along with us Mr. A. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Gogle, Head Investor Relations. On behalf of InCred Equities, we are thankful to the management for allowing us this opportunity. I would now like to hand it over to Mr. A. Balasubramanian, Managing Director and CEO of Aditya Birla Sun Life Asset Management Company. Over to you, sir.
Yeah, thank you for the introduction. And good evening to everyone. Opportunity to go through the earnings presentation, which is available on the stock exchange and our website. Let me quickly begin giving the outlook on economy and the mutual fund industry, and then give an update on Aditya Birla Sun Life AMC performance for the quarter ending Q4. The global economy, in our own belief, continues to remain uncertain, and the recent development in the financial markets of advanced economies have not helped to ease the sentiment. High inflation, financial tightening, hawkish monetary policy is expected to limit the global growth. Central banks worldwide, led by the Federal Reserve, have shifted away from dovish to accommodative monetary policy and have raised interest rates to go with inflation level. And this move has prompted investors and businesses and markets to reevaluate and adjust their expectations accordingly. The collapse of a couple of banks has led to a turmoil in the banking systems and of some advanced economies in the face of financial contagion, but effective measures by respective policymakers have largely helped containing its impact. The Indian economy, as we know, has remained resilient, surpassing global uncertainty and headwinds. India's real GDP is expected to grow at about 7%, and India's growth impulse have also been supportive by way of easing of supply chains and rebound economic activities. Easing inflation pressures in March 2023 is a positive sign. It was also driven by the softening of food and core inflation, which fell to a 16-month low. India's financial system has remained strong, led by robust banking industry, adding further stability to the domestic economy. We also seen robust tax collections in the GST, touching about 1.6 lakh crore. As a result of that, and the annual collection for the full year, including direct tax collections, going about 20.60%. Definitely, of course, putting the India's tax collections at robust level. As a result of the higher tax collection, the Government of India borrowing programs is also being helped. Going by the next year borrowing program, which has been already announced and well within our target limits, and putting less pressure on the interest rates further movement. RBI forex reserves have gradually started increasing. Now it's back to about $578 billion as of March 31st, 2023, which is again a good sign. And current account deficits have also narrowed to 2.2% from 3.7% in Q2, on account of lower merchandise trade and deficit, and robust growth in service and exports. Another positive development. The development factors such as oil prices, global financial sector uncertainty, and Indian monsoon season need to be considered to ascertain the future trajectory of the domestic economy as we speak. The economy is interestingly better placed mainly because of its reliance on domestic demand and drivers. The consumer sentiment index points to a continued recovery. And going ahead, the key growth drivers are likely to be continuously uptick on consumer sentiments and green shoots in rural recovery and commodity prices relaxing of their previous highs. In the near term, we believe that most of the risks are priced in and there is not much downside in the markets that's expected. With valuation having got normalized, the market now should start tracking the earnings growth as we move forward. With respect to the mutual fund industry, during the quarter, the Indian mutual fund industry witnessed flattish growth with the quarterly average assets under management staying close to about 40.49 lakh crore as of 31st March 2023. In FY23, the mutual fund industry witnessed mutual growth with inflows across various equity and index schemes. The industry SIP book grew from 12,328 crores as of March 2022 to 14,276 crores in March 2023, indicating growth of about 16%. And during the year, the total the NFOs that was raised, about 250 NFOs were launched and raising a total of about 62,000 crores between the fixed income and equity NFOs. As of 31 March 2023, the total number of mutual investors stood at 14.75 crores, an increase of 12% year-on-year compared to 13.12 crores as of 31 March 2022. The industry witnessed net equity sales of 41,000 crores in Q4 23 through new fund offerings and existing funds. And within the existing funds, broadly the inflows have been seen in thematic category, small and mid-cap and mid-cap and large-cap categories. A little bit on the large and mid-cap categories have seen inflows during the quarter. The increase in number of retail investors is also reflected in higher individual average AUM, which grew by about 12% in year-on-year, contributed to 50% total monthly average of AUM. The mutual fund average AUM for March 2023 from B30 cities also accounted for about 70% total AUM, which remain again constant. At the same time, 28% contribution coming from individuals and retail need to be taken into account the fall in the institutional AUM during the same period. The new SIP registrations were around 65 lakhs in Q4 FY23, and the total number of SIP accounts as of March 31, 2023 rose to 6.36 crores. Over the past few months, the tax amendments in fixed income schemes and the anticipated regulatory changes had a dual impact on the mutual fund industry. And despite this, we believe that this asset class, especially the fixed income asset class, will continue to remain relevant as one of the alternate to a fixed deposit for most of the investors who are looking for asset allocation between equity and fixed income, and that we believe that will remain even going forward. And coming to Aditya AMC performance, our total average assets under management, including alternate assets, for Q4 FY23 stood at 2.86 lakh crore. For the quarter ending March 2023, our mutual fund AUM was at 2.75 lakh crore, remained flattish compared to Q3 of 2.82 lakh crore size. And our equity mutual fund AUM again remained more or less flat, about 1,600,000 crores for the quarter ending March 23, with the overall equity mix at about 42%. As part of our strategy for customer acquisition, we added about 6.7 lakh folios in FY23, resulting in the overall folio count increasing to about 80.3 lakh folios as of March 2023. Throughout the year, we launched several initiatives aimed at increasing the size of our SIP book, and including Turbo STP, Pro Portfolio Investing, and Percussive SIP, targeting mid-sized corporate employees. And these efforts have resulted in a marginal improvement in making our SIP book to cross 1,000 crores, which again will fall a little short of our own expectations. However, it has crossed the milestone of 1,000 crores. Our multi-channel market initiatives aimed at deepening our presence have yielded positive results. Virtual relationship manager model has activated over 2,900 distributors, and through Sampark, our distributors onboarding initiatives, we empaneled close to about 9,000 distributors during the period. Regarding the overall asset mix between retail and institutional customers, retail investors as of today account for about 42% of our assets as of March 2023. As part of our overall strategy, we are also focusing on building the retail portion in both B30 and T3 market, with increased contribution coming from B30, which today stands at 17%. Our passive product offering grew by about 3 times to about 28,223 crores as on March 23. Our existing passive bouquet has also grown to over 41 products, and we have around 7 products in the pipeline. And overall customer base that got added in the passive category is close to about 4,96,000 folios that we added to the passive category, which we believe can be used for the purpose of cross-selling of the other products as well. On the PMS and AIF front, we have raised a commitment to the extent of about 734 crores. It's the first ever AIF that we launched in the equity space under the name of India Equity Service Fund under category 3. Leveraging our multi-channel distribution footprint, we collected about 734 crores, which is again beginning of our building AIF success story. We also received a SEBI clearance for another 3 more schemes, which we hope to launch in the current financial year. Regarding our offshore business, though the overall assets under management and offshore remain flat, we also received in-principle approval from the International Financial Services, which is GIFT City, for launching India ESG Engagement Fund, domiciled in GIFT City. Additionally, we are also currently in the process of launching 2 global funds in the GIFT City for getting money, for raising money in India to invest in global market, as well as move some of our overseas assets to the GIFT City soon in order to cut our cost and offer fund management services from the GIFT City itself. On the real estate front, we have successfully deployed the first investment for the Archipelago Real Estate Credit Opportunities Fund, and we are in the process of doing more due diligence of more such deals. And initial focus now has been more to create performance track record, and so in order to raise more funds in the coming years. Now, just quickly move on to the financial numbers before opening up for Q&A sessions. Q4 FY23 revenue from operation is at 297 crores versus 314 crores in the year Q3 of FY23. Q4 FY23 operating profit before tax stood at 149 crores versus 174 crores in Q3 FY23. For the year ending March 2023, revenue from operation is at 1,227 crores as compared to 1,293 crores. And operating profit before tax in FY23 is at 667 crores as compared to 743 crores in FY22. We are also happy to announce that the board has proposed 5 rupees 20 paise per share dividend as the final dividend for FY23. This total dividend declared this year per share is about 10.25 per share. With this, I'd like to conclude and open the floor for any questions that you may have.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Devesh Agarwal from IIFL Securities. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. My first question is, sir, in the equity segment, although you did share multiple things that you are doing to get the market share and increase AUM, but still we've been losing market share. So if you can give us some sense, which are the segment of, particularly which investor category are we losing market share?
Sure. Devesh, thanks for this question. As far as the equity is concerned, of course, our endeavor has been to stop the leakages, at the same time improve the overall momentum in the equity in terms of improving the market share. We have collected close to about 1,500 crores in the quarter of last quarter through the launch of multi-asset allocation fund. That again reflects our ability to actually raise funds and improve the overall market share. And second is SIP is another route through which we continuously put effort to increase the overall market share in equity. But the segment in which where we have seen the somewhat lower participation is in the HNI's category, where we have seen a lower participation in the last 1.5-2 years, especially in the equity space, which we believe that we need to catch up. Second is the category in which we are losing assets are those assets where we have seen the performance related issues which was witnessed for the last 1.5 to 2 years in 2-3 categories such as real assets and few other categories in the equity space where we have seen some bit of outflow. With the change of fund manager responsibility in the last 6 months to 1 year, we are seeing those funds now getting stabilized and coming back in terms of coming closer to the benchmark as well as coming closer to the peer group on the near-term basis. As we see that improvement coming in, we should see those asset classes which remain relevant, and we should see the flows coming back. But as I speak today, more than losing, I think the lack of participation in the whatever the growth that is coming in the industry, which I think in net sales for the whole year would have been somewhere in the range of about 79 to 80,000 crores. There the participations being missing is one which was leading to the market share loss rather than absolute redemptions coming actually losing market share.
Understood, sir. And sir, if we see on the distribution side, again, I'm talking about the equity asset, we see that the share of banking channel has been going down, and in last 1 year, it has come down by 200 basis points. So is this a decline that we are seeing across bank, or there are selected banks where our sales have slowed down?
Oh, in the case of banking channels, because we have all the banking channels, whether it is the leading banks, the private sector banks, whether HDFC, Axis, we have only seen a marginal improvement in terms of our participations, especially channels like Axis. We have seen increased participation coming in SIPs, including HDFC Bank. And these assets largely in some of these foreign banks used to get a significant market share, such as Citibank. With the general reduction in the mutual fund flows, and we used to enjoy very high market share from them, anywhere between 15-16% kind of market share. We have seen a marginal dip, which again I don't see is a big challenge. Of course, some of the banking channels goes by product recommendations. In fact, some of our products which is not part of the recommendations temporarily would have seen lesser participation coming from that channel. Compared to their own selling would have happened. To the extent I would say the share would have been less. Otherwise, if you look at historically, our market share is about 48 to 50% from IFAs, roughly about 23% from banking channels, and roughly about 24-25% coming from the Indies. And direct channel is one other channel where general flows also coming in, where we have seen a flat growth in the direct channel as well. I think these are the combination of things I would say is the dynamics rather than single channel not giving inflows or something.
Okay. And lastly, sir, if we see that over the last 2 years, although the share of equity has gone up in the overall mix, our yields have remained under pressure. Now, there will be some generic reasons for those. But other than that, specifically, I wanted to understand how has the distributors' payout intensity changed for you between, say, FY21 and 23?
Yeah. Ask Parag to answer that once again. Yeah.
So, Dinesh, the distributor payout on an overall basis as a general principle remains that we share in the range of around 65% of our overall DTER. That continues, but as you know, and we have been mentioning earlier also, wherever there are NFOs, generally in the first year of NFO, the payout is slightly higher than the 65%. Due to two reasons. One is that there is a B30 brokerage which is there, and there are some additional payout which happen in the first year, which has an impact of a slightly higher sharing against the normal this thing. So that is the only change. Otherwise, some of the NFOs which have happened has just elevated the cost a little bit. But otherwise, on the normal BAU sales, it remains in the range of around 65%.
Understood, sir. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Aditya from Equirus Securities. Please go ahead.
Yeah, hi sir. Good afternoon. Thank you for the opportunity. So first question is again on the market share. So we have seen some improvement in our market share in SIP flows, but despite that,
Lalit, sorry to interrupt you, but your audio is not very clear. May I request to speak through the handset?
Yeah, is this audible?
Yes, it's audible. The voice is not clear.
One sec. Hello?
Go ahead.
Yeah. So my question was on the market share. So in terms of in this quarter, we have seen some improvement in our SIP flow market share. Now, but in terms of AUM market share, that has not been reflecting and we have been losing market share. So just wanted to understand, in the lump sum flows, we have seen some major dip. So what could be the reasons for the same, as you alluded to that part? And also, given that we are looking to launch funds in the PMS and AIF categories in FY24. So how is the OPEX trajectory look for us in the coming 2 years?
Yeah. See, market share loss is largely on account of 1 or 2 categories in which flows have come. This is what I mentioned in my speech as well, which is essentially small and mid-cap space and ALS as a category and large and mid-cap space. These are the 3 spaces predominantly big flows have come for the industry. In fact, our flows in these 3 categories, except we have got money in the small and mid-cap fund, so in the same period, whereas other schemes did not get as much as flows which you normally get every year. So to the extent our market share loss was on account of the flows coming in, we saw an outflow in a few of those schemes, and whatever the flows that came in the big category like small cap, our flow was relatively lower than the industry. These were the primary reasons. But these flows in the industry also come through the combination of lump sum and SIPs. And then SIP flows in the small and mid caps is also relatively higher than what we historically have seen. Therefore, to the extent our deserving participations were less, which again I would attribute to the reason I just mentioned earlier, which is what currently we have more or less reversing it, which I think should help us in the next few quarters to get back on track. As far as your AIF thing concerns, the current thing is one, we have planned lining up of AIF product. There's one which we'll be closing it in the month of April. We already planned 2 more AIF this financial year, both in equity and fixed income. In terms of team strength, we already have. If at all we have to add 1 person, we will add 1 with the long short kind of capability. As far as the equity is concerned, we may add 1 person on the credit side for launch of our credit fund. Otherwise, we don't see a significant addition in terms of adding people. That's the only main cost that we have. And rest of the OPEX with respect to the AIF would not be anything significant, except people may have to just go for a travel to promote this product, which I call it as a business as usual.
Sure, sir. And so on the yields, thank you, sir. On the yield side, could you highlight the difference between the stock yields on a stock basis and the flows which we are getting, like on an overall segment wise, like in particularly in equity?
So, Lalit, basically, as you know, the stock is a little lower on the sharing basis, and the new money which comes, it is slightly higher, which is in the range of around 65% plus. So the yield on the stock is higher than the yield on the new flows which is coming. I don't have a handy number on the differentiation, but That is the case, and over maybe the next couple of years that gets merged. So the differentiation between both of them is not very significantly high. There will be some differentiation, but that will merge over maybe next 2-3 years period time.
Sure, sir. And so just last data keeping question. Can you share the SIP AUM book as of March 23? The overall SIP AUM?
It's 51,203.
Sure, sir. Thank you, sir.
Yeah. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask the question. Participants, you may press star and 1 to ask the question. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hi. Hi, sir. Just a few questions from my side. Firstly, could you give us the yield what you would have made in FY23 on equity and debt, liquid and ETFs? Some ballpark numbers.
Yeah, just a second. I'll ask Parag to give it.
So equity more or less is in the range of around 74 odd basis, absolute thing. On debt, debt is in the range of around 25 to 26 basis, 25 odd basis. And on liquid, it is in the range of around 12 basis.
Okay. Okay, that's helpful. Apart from that, if I look at your expenses in this quarter, other expenses in particular, they were higher both on a sequential basis as well as on a YY basis. What was the reason for that?
So the main reason which has contributed to the higher expenses for this quarter is on the NFO which we launched in the current quarter, the multi-asset allocation fund, which is actually we spent some of the amount on marketing and sales promotion of that NFO, which is contributed mainly for that. Other than that, there are some of the other infrastructure expenses, like we opened some of the new branches and all. So that has slightly gone up. Other than that, there are normal regular expenses. Generally, in the last quarter are slightly higher than the other quarters on traveling, business promotion, or any other spend on marketing. So that is the expenses which has come up.
And how should we think about the expenses from a next year perspective? What kind of growth do you envisage in expenses both on employees and employee cost and other expenses? Also, if you could throw some light as to how much of the cost on staff front was on ESOP front, and how do you see it in FY24?
So generally, we are looking at the expenses to be in line, growing maybe below the overall AUM growth which we will have in next year. That is the intention. Generally, it will be in the range of the inflation plus some uptake on employee cost, which we will look at it. Even on the administration side, similarly on the rentals or any other expenses which we may have. If there are any depreciation on rupee dollar, that may have an impact on the escalation, especially on the technology side. That may have a little bit impact on the overall expenses because we are highly dependent on these technology platforms and technology service providers. So that is on the expense side we are looking at.
Yeah.
Employee cost, sir?
So ESOP plan, generally it is definitely going down because it's 40-30-20-10. That is the generally hit which we get on the ESOP plan. Currently this year it was around 30 odd crore, so we can see some drop in the next year on the ESOP side.
Yeah, with respect to employee things, while we have more or less fully in place with respect to our employee force, few additions only could come in terms of employee addition. More to strengthening the team, especially on the investment side, as well as on the sales and alternate investment side, which again, I guess that there will be, of course, some compensation will also come in the form of realigning the responsibility of people and so on and so forth. But I don't see a significant increase as far as this employees cost concerned. But of course, annual increment that we normally count anywhere around the 8% to the extent one can expect.
Okay. Thank you. And also, while there are no regulations that are out yet, at some point of time, SEBI is gonna give some clarity on what the TERs are going to be, what costs are going to be subsumed in the TER. What are your thoughts in the sense of how are you guys preparing for this, and what would be kind of sharing mechanism this time around that would kind of and also on this, in case the broker is kind of subsumed into the TERs, what would be the strategy of Aditya Birla AMC? How would that kind of play out?
Right, the way I see is one, it is still under discussion stage with SEBI. While most of the expected announcements have already been appearing in the newspaper in some form or other, I presume 40-50% of that, those expectations would come. And from a business point of view, our overall vision to be scale players, that remains, is not going to be taken away as a result of this. And second is ensuring our product positioning, the investment performance is the key for us. While we are seeing improvement, but we still more work to do, which we are currently driving that. And third is in order to increase our retail penetration, while we have been predominantly working with the B2B model, at the same time, we are stepping up our engagement in terms of direct customer connect, both through the sales as well as the service. And that's something we are putting in place to ensure that direct customers connect in at least in market improves quite significantly. Therefore, it helps in building our AEM. And fourth, we also identified a few more areas which could support the retail sales, which we call it as a VRM model. So far, the VRM model used to be used only for the purpose of activation of IFAs. We are moving away from activation to the converting into sales, so that every active IFAs or every activated IFAs contribute to the success. That's something we are doing. We are going granular in order to ensure that we bring up the overall contribution to us. And emerging market, where we are seeing a significant inroad that was created for us about 2-3 years back. Once again, we are stepping up a focus in terms of increasing the penetration on the geographical footprint. As far as the distribution-led the economic model, I'm sure that will evolve depending upon how the entire the new TER structure is going to evolve. Again, I would assume the way we currently have 65-35 kind of model that we have. I would assume we'll have to stick to the similar kind of model to ensure, one, we are able to maintain some discipline. At the same time, ensure growth comes. At the same time, we are able to maintain the profitability. May not be necessarily in terms of absolute number, at least on the basis points level. That's something we will work on it. But again, Prayesh, we have to play it as it comes. It's too early to, at this point of time, jump the gun. At the same time, since we broadly know that what I think would come, at least start preparing ourselves, as I just mentioned, including, like for example, we have been a really good active player on the DMA side. So that gives us an experience to be prepared for some portion of the trades could go through the market. At the same time, we also believe that intermediation cannot be completely removed even from the equity trading point of view. Therefore, we have to do a look at a mix of both the models. But that's something we will play it as we come closer.
Thank you so much.
Yeah.
Thank you very much. Ladies and gentlemen, you may press star and one to ask a question. Participants, you may press star and one to ask a question. As there are no further questions, I will now hand the conference over to the management for closing comments.
Thank you. Thank you very much, ladies and gentlemen, for tuning in. And with this, we conclude our Q4 FY23 earnings calls. And do feel free to reach out to Prakash Bogle for any query that may have. And all of you have a nice long weekend. And thank you.
Thank you very much. On behalf of InCred Equities, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.